Hey everyone, in this video we're going over social finance, ticker SOFI, SoFi, their stock analysis. We're going to be breaking down the stock a little bit. We're going to go over their Q2 earnings. But before we get into the numbers, if you could smash the like button, it really helps the YouTube algorithm. And if you haven't subscribed to this channel yet, please subscribe. So let's get into it. SoFi closed at just under $15 a share yesterday. It was down over 14%. Now, I think that at these levels, SoFi is a buy personally. So that is why yesterday, when it dropped under $15 a share, I went out and I bought some extra shares. I added 2,000 shares at $14.96 a share. As you can see, that's my screenshot of the order executed to buy 2,000 shares, basically just under $30,000. And this is in addition to the shares that I currently had. Now, for those that are unaware, I invested in SoFi when it was a private company, pre-SPAC. So when I invested in social finance, I invested at a much, much lower valuation. And because of that, my cost basis is shown here in my screenshot at $6.26 a share. That includes the recent purchase of 2,000 shares. But it's because I invested privately. So in total, I'm holding 8,550 shares, just over $128,000 in the stock. Now, before getting into SoFi numbers, I do want to go over the bigger reason I originally invested in SoFi when they were a private company and why I continue to hold the company today and add more today at the current price. Now, that reason is basically SoFi fits into one of the thematic events that I am investing in. So there are a few thematic basically categories going on, major disruptions basically, that I believe are happening. One of those is the FinTech space and the disruption of traditional banking. Now, the banking sector is worth trillions in market cap, and banking is basically being democratized right now. This transition is allowing the underserved to be served like they never have been before. The digital space is basically taking this old industry, making it scale and vertically integrate like we've never seen before. And this entire disruption is basically going to, in my opinion, make a lot of money move from legacy banks to new digital banks. Now, as we get into the numbers, I just want to ask this one question. Who is innovating more? You know, when you think of innovation, who innovates more? If you think of SoFi, Square, Robinhood, or you think of Wells Fargo, Bank of America, JP Morgan. So in my opinion, the rate of innovation will always determine the future. Can't determine the past, but it will determine the future based on how you're innovating. Now, the first group, SoFi, Square, Robinhood, they have a total market cap right now, if you combine all three companies, of $177 billion. The second group, Wells Fargo, Bank of America, JP Morgan, if you add all their market caps, you get over $1 trillion in market cap. Now, I believe this gap between this $177 billion and this trillion is going to shrink, and that will happen over many years. But I think that basically these legacy banks will either start to come down, and at the same time, these new digital banks will begin to take some market share and start to go up. Now, I would like to point out that the legacy banks like Wells Fargo, Bank of America, JP Morgan, it's not that they're trading too expensive because they trade at very low PEs. It's just that this is a massive industry with a huge addressable market, and the digital players have only, as far as profit and cash flow is concerned, have just started. They're in the very first innings of the game. Their job right now is to scale as much as possible, grow their member base, and then from there, basically use their scale to make as much profits down the road. Now we're going to get into Q2, their most recent earnings report, but before we do, I just want to go over their SoFi's mission statement, which is to help our members achieve financial independence to realize their ambitions. So it's a very broad mission statement, and it allows them to basically vertically integrate across the entire sector so that their members can achieve independence. It's so broad that, you know, they can basically use that mission statement to tackle many things. Now, as far as their members, this is one of the most important metrics in the entire earnings report. it is going up. This is showing quarter over quarter from Q1 2019 through Q2 2021. They have over 2.5 million members right now in the latest quarter. But the most important metric is if you look from Q3 2019 through Q2 2021 at the year-over-year growth, it is not only growing year-over-year, but the growth year-over-year is accelerating. So it's going from 37% to 50%, to 54%, 59%, 74%, 90%, 110%, and in this most recent earnings report, 113%. So it's not just growing like, oh, we grow 50% every year, year over year. It's accelerating the rate in growth. So this is a massive, massive, important metric to be looking at because the members basically dictate everything else. Nothing matters if you don't have the members. Now, as far as how many products they're offering, they are accelerating growth in their product offerings as well. If you see, they have over 3.667 million products. This is basically outstanding. They are able to offer more products to more members, which will lead to more cash flow down the road. And like we see in the other one, year-over-year growth, if you look at Q4 2019 forward, we basically just have increased accelerated growth rates. In the next slide, we see Galileo accounts accelerating growth as well. We see that they've been accelerating for a long time, a slight decline in acceleration, but still massive growth, 119% in the most recent earnings report. 79 million members. I mean, this is massive accounts. This is their technology backbone, basically. They acquired Galileo. So SoFi owns this company, but Galileo's products and software is used by many developers and other companies. They have over 79 million accounts. That's a massive, massive customer base for that. Next, SoFi is showing their lending products as well as their financial service products on the right. They basically have growth in both. There is 243% year-over-year growth for their financial service products. So that is massive growth. The trend is pretty clear. More products, more members, and that obviously will end up equaling more profits. Now we're going to look at revenue. If we look on the left side, their quarterly revenue came in at 237 million. This is 74% growth year over year in comparison to the 136 million that they did in Q2 2020. The revenue has been increasing. It's a nice steady trend upward. They did have a big bump in revenue in Q3 2020, but basically overall nice year-over-year growth, and their adjusted EBITDA came in at 11 million. This is an improvement of 35 million year-over-year compared to the loss of 24 million in Q2 2020. Now, the EBITDA, because of growth and different things, acquisitions, etc., we are seeing it kind of sporadic, where it had some up quarters, it had some down quarters, but overall I do expect their earnings to continue to grow year over year. Also, Anthony Noto, the CEO, did say on CNBC yesterday that they expect to have about 30% of their earnings drop to the bottom line and then take 70% of them and reinvest them for growth into the future, which is exactly what I'd like to see. Now, annual performance, not just quarterly, we're looking at this really nice trend in revenue going from 2018 until now of just really great growth, 241 million to 451 million to 621 million, and they're expecting 852 million. As far as earnings, we see that year-over-year earnings, clear trend upward, and we have just passed the break-even point now into profitability. That is a really, it's great to see that happening, even with the company still being relatively so small in comparison to the addressable market. Now let's go over guidance. Last quarter, they gave guidance for Q2, and they beat their original guidance. Their original guidance was 215 to 220 million in revenue. They did 237 million. So this represented a 17 to 22 million dollar beat, so basically 8 to 10% beat on revenue. Now their earnings, they did 11 million in EBITDA, and that was versus a guidance originally of a loss of 8 million to a gain of 2 million. So this represented a $19 million beat on the low end and a $9 million beat on the high end of that range. So beats on revenue and earnings in comparison to their last guidance, and now they're giving guidance for the next quarter. For Q3, they're expecting continued strong growth. They expect 245 to 255 million in net revenue, which would be higher than the 237 million that they did this quarter in revenue. And they also are expecting either a loss of 7 million to a gain of 3 million in adjusted EBITDA. They do say this is despite the fact that the moratorium of federal student loan payments isn't ending until September 30th, as originally anticipated. It was expected to be over. So that affects their business, but it doesn't, these are like one-time things. This isn't going to affect them long-term. So as far as their actual earnings, their revenue is going to continue to grow, which is important, but their earnings, I expect them to beat. I think that Anthony Noto is a great CEO, and I think the company's management wants them to beat earnings and beat expectations quarter over quarter and year over year. So I think that they rather guide low and then beat, and that's a good strategy for the long run, in my opinion. Now, as far as guidance for the full year, they are guiding for $980 million. That's 58% revenue growth year over year for 2021. They didn't increase guidance. This is the same guidance they gave in the past, but the thing is they had a better first half than they originally expected. So this is what made the stock drop, is that even though they had a better first half, if they're not going to increase full year guidance, it means they think they're going to have a bad second half. Now, that is something that Anthony Noto did say on CNBC. He made it clear that because of these changes to this student loan situation, that will affect the second half. But because they also believe the business is going to continue to grow, they're just not going to change guidance because the business is growing better than they expected. But then we have this negative side of they weren't expecting this delay for the student loan payments, etc. Now, they expect 2021's contribution profit to be 27% at 266 million. This is better than 2020 at 26%, and obviously better than the past where there was a loss. As far as adjusted EBITDA, they're expecting 3% to go to the bottom line, basically, for adjusted earnings. And it's the first year where they're expecting a profitable adjusted EBITDA, so this is the turning point, in my opinion. The bottom line is revenue, earnings, everything is trending in the correct direction. It is going up year over year, as well as members. This chart here is just showing you member growth, year end 2018, 2019, 2020, and the first quarter of 2021 on the left, and the second quarter, our most recent one. Everything is trending upwards. More members, more products, more revenue, more profits. These are all basically great things. Now, according to Yahoo Finance, only 3.81% of SoFi stock is held by institutions. If this is true, which is what it's showing, so I believe it to be true, that's a very small amount. There's so much room for big industries, big hedge funds and institutions to get into this stock. And then I also looked into their short interest, and I saw that as far as short interest for percentage of the float, there is 24.32% short interest of the float. This is a huge percentage. Now, to be clear, it's a low percentage of all shares when you include restricted locked up shares. But of shares that are available basically and publicly traded, being held by retail investors, etc., 24% of them is short. So it's this high short interest that could lead to, I'm not saying we're going to have a short squeeze or anything like that, but it's definitely, all those people eventually, if this company doesn't go under, and based on their number growth, I don't think it will, they'll eventually have to cover, which will create some buying pressure. It's a quarter of all shares that are available as of right now. Now, as far as tip ranks, they currently have only 2 ratings on this stock. They're both buys. The higher price target is $30. The lower price target is $23. These are 12-month targets. Averaging those 2 targets, you have an average price of $26.50. That represents 76% upside in the next 12 months on a consensus basis between these 2 analysts. For myself, I don't personally have a 12-month price target, The way I look at it is SoFi currently trades at a market cap of under $12 billion. It's competing in an industry that many banks are trading in for hundreds of billions of dollars in market cap each. And for me, there are certain thematic investments that I make that I have to think of these types of thematic investments in terms of decades, not in terms of quarters or even 12 months out. Now, the reason I have to think in such a long time horizon for this type of investment is this is something that's going to play out over many, many years, and it gives an investor an advantage if they are able to have a long-term outlook, because it gives us the ability to do something that analysts are not able to do. All of Wall Street, all of institutions, analysts, they have to think of how are they going to perform on a quarterly basis, on a yearly basis, month over month, because if they don't have the right numbers in the short term, they can lose their job. So they're not able to take 5-10-year stances on companies. And that gives this basically sliver to the retail investor to be able to take advantage and buy things that may not be, as profitable as it needs to be in the next 3 months, the next 6 months. But in the long term, they have the potential to significantly outperform the market. Now, if you've made it to the end, I'd really appreciate you smash the like button. It really helps the channel. And if you haven't subscribed yet, definitely subscribe for all future analyst videos, research videos, earning report videos, and all different things. We're going to be doing a video probably next week on my journey, my investment career, how I got to where I am now. So if you're interested in that, definitely subscribe and get notified for that. And yeah, until next time, guys, thank you for watching.